DF Limited acquired 100% ordinary shares of rupees 100 each on of XYZ Limited on 1st of October and 31st March 2002. The summarized balance sheet of two companies was given below. Building, machinery, investments, inventory, financial assets, trade receivables, cash, equity, other equity, reserves and surplus, other reserves, retained earnings, financial liabilities, bank overdraft, trade payables. The total retained earnings of XYZ Limited showed a credit balance of 3 lakh on 1st of April 2001, out of which dividend of 10% was paid on 1st November 2001. DF Limited recognized the dividend received to P&L. Fair value of plant and machinery on 1st of October was 20 lakh. Rate of depreciation on plant and machinery 10%. Following are the increase on fair value in Ind AS with the book value at 1st of October, which are to be considered while consolidating the balance sheets. Trade payables, land and building, inventories. It is assumed that inventory is still unsold on the balance sheet and trade payables are not yet settled. Also assume that the other reserves of both the companies on 31st March are same as that of 1st of April. All the fair value adjustments have not yet started impacting consolidating post-acquisition profits. Investment is carried at the cost in separate financial statements. Appreciation of 10 lakhs in land buildings entirely attributable to land only, which means no depreciation impact. Depreciation on machineries on WDV method. Acquisition on the date of fair value adjustments to inventory existing on the balance sheet date does not result in any write down. Prepare the consolidated balance sheet on 31st March 2002. You can see that quite a few adjustments are there. No need to worry about it. So we can prepare our regular working note format. Before that, let's just understand this pre-acquisition how much, post-acquisition how much. That will help us while preparing the our working note format. Fine, let's do that first. So they had, if we look at the XYZ the liability side, they had other reserves 10 lakh, retained earnings 8 lakh 20. We should divide this into pre and post. So other reserves 10 lakh. On the balance sheet dates, other reserves is 10 lakhs. Look at only XYZ subsidiary company. We'll divide this into pre and post. For that, I'll just make it as opening balance and current year. So other reserves, I'll make it as opening balance and current year. Have they given how much was the opening balance at the time of acquisition? It may assume that the other reserves of both the companies are same as on 1st of April. So I think a 10 lakh beginning and 10 lakh end. No, same thing. No, other reserves was same on the opening and closing. So current year balance I can say zero, right? So nothing, zero. Opening is the entire 10 lakh. So current year is zero. And opening balance is what we are going to treat it as pre-acquisition profits. Anyway, post-acquisition, nothing is there, zero. We can ignore it. So entire 1 lakh, we'll take it as pre-acquisition profit. Okay. Then coming to retained earnings, balance is balance sheet of XYZ Limited. Retained earnings is 8 lakh 20,000. But you know, one thing should be done. The dividend paid is there, right? Don't worry about pre and post. You simply add back dividend paid. So basically, I want to know the position as if dividend was not paid, what would be our balance? Why is it required? Because you know, I need the net assets on the date of acquisition, reserves and surplus on the date of acquisition. Once you pay dividend, the reserves might have reduced and increased. Confusion will come. To avoid the confusion, to simplify the process, when there is dividend payment, simple adjustment. What is that? Whatever dividend paid, propose you don't worry, declare you don't worry, that is outside the balance sheet, that will not be adjusted at all. Dividend paid during the year will be added. How much dividend paid? 10%. 10% of share capital, 20 lakh. That means 2 lakh. Dividend paid, 2 lakh. This I will divide, this total means we get 10 lakh 20,000, which will be divided as opening and current year. Opening balance. The opening balance showed a credit balance of 3 lakh, and therefore current year will be 7 lakh 20,000. Hope you're writing down these things, because institute solution format and our format, I mean, the presentation is slightly different. So I want you to write down these things. Hope you're writing it down. That is the reason. But what I would tell is simply you add dividend in all the cases. In the consolidation problem, especially full-fledged problems, once the acquisition happens, after that, any dividend paid after 1 year, 2 year, pre, post, don't worry anything. Date of acquisition happens, 1 year later, 2 year later, 3 year later, 6 months later, anytime they distribute dividends, you add back first. The reason is I want to have the opening balance comparison, right? Because when you pay dividends out of this balance, there will be some not a direct comparison. So simplest approach is once dividend paid, you simply add back. Don't worry about the pre and post. That is important. Yes, later I will reduce it. In the working note format, whatever paid entry, I will give a effect there. So ultimately it will get adjusted, plus minus. Okay. So 3 lakh here, 7 lakh 20,000. I hope you're also writing. Now this 7 lakh 20,000 I have to divide into two parts again, because acquisition took place on 1st of October, means half year is pre and half year is post. So I will say up to 1st of October, or up to date of acquisition, up to 1st of October and after 1st of October. Now opening balance is definitely pre-acquisition, and up to 1st of October is also pre-acquisition. After 1st of October is post-acquisition. After October, after date of acquisition. So while preparing the working note format, one thing I can do, I mean, how much? Divide equally. That is 3 lakh 60, 3 lakh 68, right? Half. You get 3 lakh 60, 3 lakh 60. 6 months, 6 months. Divide in the ratio of number of months. So while writing the working note format, one thing you can do is you can do 3 lakh plus 3 lakh 60, 6 lakh 60, you can say pre, or you can say 3 lakh one line, 3 lakh 60 one line, which is comfortable to you, you can follow it. Does not matter. And yes, this dividend pay 2 lakh, I'll be subtracting it later in the working note format. Okay. Next, some more working note we'll do, that is regarding this something revaluation, something is there. And fair value of machinery on 1st of October is 20 lakh. But fair value of the machinery 13 lakh 50,000. I would like to know what would be the value in the beginning and have to keep it down, then have to calculate the revaluation. So I will do that. I'll show you the calculation format. Very simple. You'll be able to follow. But any doubts in these calculations? Are you done with writing down this part? Yes. Okay, good. So revaluation part alone, I will just show you the calculation. So revaluation of machinery or furniture. Which one was that? Revaluation of plant and machinery. Okay. You can follow the simple formats. You can do like this as per subsidiary company books. Then as per consolidated books. Then incremental or differential. So as on 1st of April 2000, what is the date? This is on 31st of March 2002, 1st of April 2001. Yeah. The value, we don't have it. We only have the year end value. And rate of depreciation is 10%. Year end value we have. What is the year end value on 31st March 2002? The year end value is 13 lakh 50,000. So if I have 100 rupees as my book value, 10 rupee I provide depreciation, remaining will be 90. That 90 representing 13 lakh 50,000. So 13 lakh 50,000 is 90%. How much for 100%? That is 15 lakh That's the beginning amount. Then provide depreciation less depreciation from 1st of April 2001 to 30th of September 2001. That is up to date of acquisition for 9 months. Sorry, for 6 months. On 15 lakh into 10% for 6 months, which will be 75,000. So what you get is at this point in time, on the date of acquisition, WDV on the date of acquisition on 1st of October 2001, 14 lakh 25,000. Now this is being revalued at of 20 lakhs. So incremental, that is the revaluation profits. 20 lakh minus 14 lakh 25,000, 5 lakh 75,000. Then depreciation for subsequent period after date of acquisition from 1st of October to 31st of March. That is on this will be same only, which is what 75,000 only. You will provide on 15 lakh only, which is 75,000. But here you will provide it on 20 lakh. So 20 lakh into 10% for 6 months. That is 1 lakh. So incremental is 25,000. Okay. So what and all will happen now? Of course, you can check the balance now at this point in time. WDV on 31st of March 2002. This would be 13 lakh 50,000 and this has to be 19 lakh. And the difference is what would represent 5 lakh 50,000. But anyway, we don't show 5 lakh 50,000 net effect. This 5 lakh 75,000 is the fair value adjustment or it's a revaluation. Fair value adjustment or you say revaluation relating to machinery. And this 25,000 is the incremental depreciation. Incremental depreciation. Okay. Now I'll go for regular formats. Hope you are comfortable till here. Working note formats. So particulars, amounts, holding company, percentage, I mean goodwill calculation or gain or bargain purchase. Con-PL basically means other equity. Remember, it is other equity and NCI. In this problem, holding company share 100%, I think. So actually, NCI column not required, 0%. And NCI column not required means the best thing is you don't have to worry about the method of NCI. Fair value method, proportionate method, does not matter. Anyway, so let's start with the subsidiary company. Let's start with share capital, amount of subsidiary company share capital 20 lakh, and entire amounts you can say it will go to goodwill column only because 100%, and NCA share is 0%, nothing. Then revaluation amount, okay, no problem. Yes, this is the slide. Done. Okay. So share capital is done. Then other reserves. I think other reserve entire was pre only as per our calculation. Entire 10 lakh is pre. So entire amount will go to goodwill calculation because pre-acquisition. So nothing to NCI. Then we have retained earnings. Retained earnings, we have three things. One is the opening balance, then current year up to 1st of October, and current year after 1st of October. So opening balance is pre, up to 1st of October is pre, and after 1st of October is post. So opening balance is 3 lakh, and this is 3 lakh 60,000, 3 lakh 60,000. So opening will go to goodwill calculation, nothing to NCI. Pre-acquisition also goodwill calculation, nothing to NCI. Post-acquisition, no goodwill, it will go to ConPL, 3 lakh 60,000. Then adjustments one by one. Fair value adjustments on plant and machinery, what we just calculated now, 5 lakh 75,000. Again, it's in the nature of pre-acquisition because it is done on the date of acquisition. So entire 5,75,000 goes to goodwill column, nothing go to NCI. Then depreciation on above, that will be post acquisition amount, 25,000 within brackets, not goodwill column, con PL column. Again, if NCI is there, I would have given to NCI column as well. Other adjustments, fair value on trade payables, fair value on land and building, fair value on inventory. Everything I can do put together. I can do one by one also, but ultimately net amount. So I just do fair value adjustment on other items. You can do one by one. I can save some space. You can do one by one also, no problem. So building 10 lakhs plus inventory 1 lakh 50,000. Everything upwards only, no? So no problem. Then trade payable increase means it's a liability. So minus 1 lakh. 10 lakh 50,000. Entire amount actually again I guess space I'll just do directly in the goodwill column. I should write in the amount column, but I can just save some space there. So directly I'm writing it in the goodwill column. Basically, if it was the NCA was there, yes, that also would have given some share. But for reference, I'm writing it 0. Okay, any other adjustments? Dividend paid is there. Dividend paid. We added back 2 lakh. Entire amount, you can take it to con PL. No, it's paid out of reserves. You can take it to con PL. And NCI, you can say nothing. If something was there, again some percentage, I would have subtracted from NCI. Any other adjustments like you have unrealized profit, something like that? Fair value adjustments, investment credit cost, appreciation of 10 lakh is only for land, depreciation machinery, acquisition fair value adjustment does not write down. Yes, that's all I think. We can go for holding company. You can write investments in subsidiary within brackets 34 lakh. So you can take it to the entire amount to goodwill column. Then your holding company's other reserves. Here pre post does not matter. And holding company's retained earnings 24 lakh, 5 lakh 72,000. Nothing goes to goodwill, entire thing to con PL 24 lakh and 5 lakh 72,000. See total. Do you have any goodwill? If negative comes goodwill, positive comes gain on bargain purchase. Sorry, why did I subtract 10.5? That's a profit. Sorry, 10.5 is not subtract, it's positive only. Positive only. Are you getting gain on bargain purchase something? Eighteen lakh 85,000. And therefore, other equity amounts 3 lakh 60, 25, 2 lakh plus 24 lakh plus 5 lakh 72, 5 lakh 97, 3. 35 lakh 7,000. 3107 is it total? Three 60, 25, 200, 3107. Okay, 3107. So gain on bargain purchase also will be part of reserve surplus only. So what will be the total other equity? Uh, 3107 plus 1885, 49 lakh 92,000. This is what ultimately going to come in the balance sheet. Okay, so let's go for balance sheets. Maybe we can do one small adjustments, kind of notes regarding that some adjustments and all to be done. But please make sure you've done till here. Done? Oh, very good. Okay, let's go for the balance sheet format. Before going for balance sheet, a lot of adjustments are there, so we can do a note kind of thing for our reference. Especially we require for PPE. Only for that we'll prepare notes to accounts. On other things I don't recommend. Only on PPE is what I'm recommending, because 2 3 items are there. So we are building machinery. So what we can do is like a holding company, subsidiary company, adjustments, net balance. So we have plant and machinery, holding company, plant and machinery was 24 lakh. Subsidiary company, plant and machinery, 13 lakh 50,000. Adjustments we have done. Revaluation profits, 5 lakh 75. Then depreciation, 25,000. So net balance, 40, 43 lakhs. Is this table enough rather than textbook working notes? I'll discuss. I'll discuss the format slightly at the end of once I'll prepare the balance sheet. I'll discuss the general points. Then we have land and building, holding company, 15 lakh, subsidiary company, 18 lakh. Adjustments is there. Fair value adjustment was there. I think 10 lakh. So total 33 plus 10, 43. This is also 43 lakh only. So total is 96 lakh then for property, plant and equipment. Eighty-six lakh. Okay. This one working note is sufficient. We can prepare the balance sheet. All other adjustment I'll show within brackets there itself. Okay. So let's go for the consolidated balance sheet. As on 31st of March 2002. Okay, so we'll start with particulars, note number, amounts, start with asset side, which is non-current assets, Under that, we write PPE. We have just written note also, total 86 lakhs. Then, if goodwill was there, that would have come as intangible assets. No goodwill here. Current assets, below that, we write inventories. So, what are the amounts we had along with the adjustments? Inventories was 12 lakh plus 3 lakh 64 plus the adjustment was there. I think 1 lakh 50,000. Seventeen lakh 14,000. In the exam also, you can show the calculation like this. You don't have to prepare a note for and all. Inventory is done. Financial assets. We have two things. One is trade receivables and cash equivalents. It does not require any adjustments. Trade receivables 5 lakh 98 4 lakh. Nine lakh 98,000. Cash and cash equivalent, simple addition again. 1 lakh 45 80,000. And don't worry about dividend payment and all, it's already subtracted. So you don't have to subtract dividend, just addition of two items. 2 lakh 25,000. So total 1 crore 15 lakh 37,000. Okay, coming to equity and liabilities. Coming to equity, we write three things. One is share capital, only holding company, then other equity, then also we write NCI. In this problem, zero, but still as a format. Share capital, only holding company, share capital 50 lakh. Other equity, I've done the working notes 49 lakh 92,000. NCI, zero in this problem, but in some other problem it might come. Then non current liabilities. Do we have any? I think nothing. Then current liabilities. We have under financial, liabilities. We have bank overdraft and all, and then we have trade payables. Trade payables. Then we have short-term borrowings. The short-term borrowings, the bank overdraft. Trade payables. Trade payable adjustment is there. Remember 4 lakh 71, 1 lakh 74. Then adjustments was also there. 1 lakh. You should add 1 lakh. I think it comes to 7 lakh 45. Bank overdrafts only 8 lakh. Direct amount you write 8 lakh. And see if the balance sheet is tallied. One crore 15 lakh 37,000. Can you show working note 1? I'll show it. Just make sure everybody's done till here. Done? Okay, very good. So somebody want the working note 1? I think working note what one you mean is this pre and post classification. Planter machinery. Okay, this one. Oh, balance sheet note 1. Okay, okay. This okay. Hope it's done. Done. Okay. So few small points of clarification regarding presentation in exam. First question: should you write notes to accounts? Does it carry marks? The answer is very interesting. If you don't write notes to accounts, they will deduct marks. If you write notes to accounts, they may not give you marks. Can be confusing. I'll clarify. If your answer is correct fully, like in this problem, and you don't write notes to accounts, they will deduct marks. But if your answer is wrong and you write notes to accounts, just for writing the formats, they don't give you marks. Hope you understand the importance of notes to accounts. The notes to accounts is valid only if your answer is right. So what I recommend in examination is write our working notes, write the balance sheet, leave some space, 2 3 pages. Go to next problem, complete the paper. If time permits, come back and write down this. Why it is important, even if your answer is right, if you take the writing the notes in the format of HCI, it will take about 5 6 minutes, and you might get 2 3 marks. But in those 5 6 minutes, you might solve some share based payments problem, some financial instrument problem quickly, and there you lose the opportunity of scoring maybe 8 marks. You score 3 marks, you lose 8 marks. Your opportunity cost loss, right? Instead of that, don't write the notes. You leave 3 marks, it's okay. First of all, your answer should be right. Then only the 3 marks you can even think of. Instead of those 3 marks, you can score some 8 marks question. You have an opportunity gain, right? 5 marks, and 5 marks can be crucial. 35 to 40, 195 to 200 can be very crucial at the end. But there's also one more point you have to keep it in mind. You will gain 5 marks provided you know the 8 marks question that you can solve. What if you don't know that 8 marks question? At least this 3 marks question come. You come and write the notes to accounts. The question of opportunity cost arises only when there is opportunity, isn't it? So you write the question, leave the space, go to the next problem, complete the paper. If time permits, usually FR is always lengthy paper. If time permits, come back and fill up the notes to accounts in the way which institute gives the format. But according to my opinion, more often than not, you will not have the time to write down. What I would recommend is, even if you want to write the notes to accounts, write note 1 PPE, or maybe note 2 for other equity. Other notes I simply don't recommend. Not only for this, for other subjects also same thing applies. Writing amounts in rupees, drawing the lines, unnecessary things. You use the shortcuts. PPE, use the shortcuts, is okay. Standard shortcuts. Complete the paper. If time permits, come back and do all these, I would say, cosmetic changes, drawing the lines, underlying, amount in rupees, particulars, a working note, the heading you give. Use shortcuts. Complete the paper. If time permits, we do all these fillers, which I usually doubt whether you will have any time in examination condition. Okay, one more point I would like to discuss. This balance sheet total ideally should tally, and ideally it will not tally in exams. You know it. There'll always be a difference. Now, which amount you should write? Asset amount should be written or liability amount should be written? Of course, you should be same. I'm talking about situation which happens in exam where the amount does not match. And don't show sincerity here, huh? I'm very sincere, sir. I got different total. I wrote different total only. Don't show your sincerity here. According to me, if you write the balance sheet total different amount, it's a professional misconduct. It's a crime, in my opinion. Whether you get it or not, write the same amounts. Which amount should be written? According to me, write the asset amounts. Liability where, asset amount is this. Liability is where you will have higher chance of going mistake because NCI is there, other equity is there, quite a few things could be there. So the chances of going wrong in the liability side is more. So write the asset amount on both sides. Then I would recommend 3 simple steps to rectify this difference total. First step, you identify the difference and look for the adjustments. You might have missed that. For example, 1 lakh is the difference. Maybe trade payable 1 lakh you forgot to add. Or 1,50,000 is the difference. Maybe inventory you forgot to add. First thing. Second thing, the difference whatever is there, right? Divided by 2. Why divide by 2? You might have done the reverse adjustments, opposite adjustments. See, this trade payable you're supposed to add here. In the working note is subtracted because liability. But in the balance sheet that 1 lakh should be added. You forgot to do, you did minus 1 lakh. then the balance sheet total will be 2 times difference. The balance sheet total will be 2 lakh. You divide by 2, now you find 1 lakh. That adjustment you can search for it. That was point 2. Point 3, whatever is the difference you have, divided by 9. Why the difference should be divided by 9? There is every chance you have interchanged the numbers. For example, instead of writing 5 lakh 98, you made 5 lakh 89. So when you interchange the numbers, there is a possibility, or whenever you interchange the number, the difference is always divisible by 9. So when you divide by 9, if there are no decimals, then look for these kind of things. You might have interchanged the digits. When you divide by 9 and it does not have any decimals, full numbers you get. In those cases, you might have interchanged the numbers. Yes, it's called as the transposition errors. Anyway, I will just say interchange of numbers. At least I have that problem. Still today I have it, I think. Beyond this, of course, you are capable of doing your own extraordinary mistakes. You have to identify yourself by solving more number of problems. But anyway, this is the standard techniques I can share with you, which is used a lot historically, also traditionally, to identify the mistakes when the balance sheet does not tally. Okay, so I hope I've addressed the issue of writing the notes, the examination, what time recommendation. If time permits, write down. Otherwise, don't worry about it. Okay, any doubts in this case? Yes, we have shown the calculation, right? In the our working notes, we got con PL, other equity 31 lakh 7,000. Then is gain on bargain purchase, we got 18 lakh 85. So both of them we have summed it up. We have shown it here. Gain on bargain purchase. That's why. If it was goodwill, then this goodwill would have come in intangible assets, and this 31 lakh 7,000 entirely only would have come in other equity. Okay. Okay. So let's go further.